This is our second video lecture for Chapter 13, where we're focusing on the tax rules for nonprofit organizations and some performance ratios to evaluate how well our government or nonprofit is doing. Before we take a look at some detailed tax rules, let's um, let's get a blank screen here. So almost all organizations, be they profit or nonprofit, want to receive money, income or revenue, so they can pay out their expenses or costs. In the case of a profit organization, they want to have a profit or so-called net income. For tax purposes, we call this amount the taxable income, to which we would multiply this by some type of tax rate to get the tax for the year. In the case of a nonprofit organization, this excess revenue is non-taxable. In the case of a profit business, this excess revenue is taxable. To be a profit or nonprofit organization, your entity has to register with the government, and it's not necessarily with the federal government. But most organizations get first recognized by their state. So here in Hawaii, you would go to the state's Department of Commerce and Consumer Affairs, specifically to the Business Registration Division, and register your entity, be it a profit or a nonprofit entity. In this case, this is an example of a nonprofit corporation. You could also set up nonprofits as a trust. So once you file with the state, once you register with the state, now you have a legal entity to do your business, be it profit or nonprofit. You also should be registering with the IRS, not to be recognized as a nonprofit, but just to get a ID number. So the form, you can't see it up here, but it's a form SS, I believe, number 4, with some name and contact information, including what type of entity you are, like a non-profit, like a church. Now you got an ID number, an employer ID number, but that still does not make you tax exempt or a charity. To be able to be recognized as income tax exempt, that's what we're talking about here, yeah? Net income taxes, not sales taxes or excise taxes, which you may or may not be subject to if you're a nonprofit. But we're talking about income taxes. So if you're exempt for federal income taxes, you're probably also going to be exempt for state income taxes, not counting any real estate tax or excise tax. To get this tax exemption, you have to file this form 1023 with the IRS. Now, this does not make you a charity. It just makes you tax exempt if you get that approval. To be a charity, you have to also again get permission from the IRS. All tax exempt organizations fall under a Internal Revenue Code called 501 letter C. Then there is a whole bunch of numbers. To be a charity, you have to be a 501c3. Again, the 501c means your excess profits, your net income, your taxable income is exempt from income taxes. It does not mean that whoever gave you the money can claim a charitable deduction. That's only true if the contribution was made to a 501c3, okay, number 3. The most common 501c is a charitable organization, so with this number 3. So here's a whole bunch of 501c. Again, the most common is that number 3, and the main one is, of course, charity or churches, yeah? So when you give or contribute a donation to these types of entities here, you can claim a charitable deduction. if you make a contribution for these other types of 501(c)s, there is no charitable deduction. For example, I believe political organizations would be a 501(c)(4). Political contributions you cannot deduct as a charitable contribution. Or how about if you're a credit union? Yeah, you're tax exempt for your profits, but if you make a contribution to a credit union, you can't take a deduction because they're not a charity. What's some others here? Um, Chamber of Commerce. Here's your Board of Realtors. They're tax exempt. So if you make a contribution to these organizations, maybe you can claim a business expense, not a charitable deduction. Again, the form to file, here's the IRS site, Form 1023, which could be a couple dozen pages long. There's an easier form here, 1023 Easy, based upon your expected income and asset limit. You also now have to register again with the state if you are a charity with this tax and charity division. This is usually a one-time registration. So now you're on record with the IRS, hopefully, as a charity, 501(c)(3), if you qualify, versus those other numbers, and now also with the state listed as a qualifying charity. There are annual filing requirements, tax filing requirements, called a Form 1099 that you file with the IRS. And this form is usually made public to anyone interested in looking at the organization's performance. There's different types of 1099s. This regular one would be about a dozen pages long versus a half dozen for this 1099-EZ versus just a few questions online with a 1090N, not 1099, but 1090, yeah? Here's the beginning of the 1090 form, just a half page of the first of a dozen pages long. Now, it would be unfair for a charity to compete with a regular business because a charity, remember, is tax exempt, where a business is taxable. So if your charity runs a business that's unrelated to their nonprofit cause, any net income from that business is going to be subject to tax like a regular business. To make it an even playing field, so you don't have any advantage over regular businesses. In fact, if you take a look at this one here, remember that credit union? Banks don't like credit unions because credit unions are tax exempt. The taxes they save, they give better rates to their members, right? Versus, let's say, a bank which has to pay taxes, going to charge more on their loans, going to pay less on their deposits. Well, that's just the rule. There's a lot of lobbying here to get rid of that advantage for credit unions. So if the charity has so-called UBIT, you're going to have to pay taxes on that if it exceeds $1,000 for the year. Now, what's a tax rule without exceptions to the exceptions? So here, maybe the business income is not subject to tax if the business is not carried on regularly, maybe periodic, once a year. If it's run by volunteers versus paid workers. Here's your Salvation Army, Goodwill, kidney card donation, tax-free to the charity, the profits. If the operation is being run for the convenience of your charity, maybe like a cafeteria, that profits could be tax-free. In the case of our campus, I believe it's subcontracted to a private business, so their profit is taxable. I think it's called the spot. Other types of income that may be exempt from taxes: if you have investment income, including maybe even rental property, real estate, that could possibly be within certain limits, be tax-free for the nonprofit. Research by its nature is scientific, so any proceeds probably is tax-free. Here it says public entertainment, trade shows are all tax-free income, generally tax-free. There's always exceptions. And in addition to the regular 1099 form, here's a 1090 form, the 1090T, taxing the unrelated business income, either at the corporate rate, if it's a corporation, or trust rates, in the case of a trust. Let's take a look at the last part of our chapter 13. We're going to determine how well the organization is doing. In past chapters, in previous classes, we basically were trying to prepare financial statements, be they reporting a good performance or bad. But now here you can determine whether it's good or bad. And one way is to compare dollar amounts. But maybe you want to compare different organizations, yeah, not just one organization from one year to the next year. The best way to do that is to common size, so change all the dollar amounts to percentages. So based upon the financial statement you're dealing with, you usually look for the largest amount, typically a total of a category, like total assets on the balance sheet or statement of net position in the case of a nonprofit or government, or maybe total revenue or total tax collected in the case of an income statement or statement of changes. And you divide that total amounts by all the other amounts on that same statement to get a percentage. And what you're doing now is looking at the percentage from year to year to see changes versus the dollar amounts. Or you're looking at percentage of one government compared to another government's same category. And basically, you're always looking early years as a trend. Are things increasing or decreasing? Are your amounts larger or smaller compared to other comparable organizations? Ratios, especially for nonprofit organizations, are important. This is how well we this is how we determine how well the nonprofit is performing in meeting their mission. What we want to do is whatever money they're spending, we want it to be for their services, their nonprofit services. Now, there's other costs being incurred by this nonprofit that don't go to direct services to their clients, to their needy recipients. Those are usually administrative services, administrative costs, and fundraising costs. We try to minimize that as much as possible and spend more on program services. So this ratio here, we want it to be as small as possible. Our textbook says, the Better Business Bureau says maybe a percentage of 65% or higher is okay, is good. To raise money for nonprofits, you usually have to spend money, but you want to spend as little as possible to get that most bang for your buck. So this ratio here, we want it to be as low as possible. Here's an example of our local Oahu United Way results for, I can't remember what year this is, probably a very current year. And the amounts were determined, these ratios were determined by amounts reported on that form 990. So looking at the program expense ratio, this is pretty good, right? Remember our textbook said 65% is okay. Here, 83% of all the costs being expended by Aloha United Way goes directly to programs. How about this fundraising efficiency? It takes 11 cents to raise $1 of charitable contributions. Okay? And you want this to be as small as possible. Trying to analyze governments. To tell you the truth, most citizens and voters don't look at the government's financial statements. Even the elected legislatures may use only selected amounts on the financial statements to further whatever cause they want to push. The big users of governmental financial statements are people who invest in the government money now, not just their time and efforts. Basically, what the government is selling is not stock, but bonds. Bonds are probably the biggest market, comparable to the stock market. And the government wants to pay as least as possible for borrowing money. So what they want is to have good ratings from Moody's or Standard & Poor's or Fitch. And the higher the rating, here using letters or numbers, the lower the interest rate that people are willing to accept and lower costs to the government. So let's take a look at, let's see, the University of Hawaii bonds is rated AA2, which is pretty good. The best rating, which hardly anybody gets, is AAA or AA1. So with the AA2 rating, the university can borrow at a lower cost than most other types of government entities. So there's different types of ratios. Certain ones are based upon trying to analyze the liquidity, the short-term debt paying ability of the organization. So just like you've seen for regular businesses, you have something called current ratio or quick ratio, where you're looking at the current assets divided by the current liabilities. And depending upon the amount of money collected over the year, and governments always collect money, you want to be able to make sure you have enough of this to pay off this. So possibly a little over a 1 to 1 is okay. Where money is being collected seasonally, then you probably want to have this as a little higher number than the liabilities. Solvency is the probably long-term viability of the organization, where you're looking at all the liabilities and all the assets of the organization. Here's something like the times interest earned we've learned in business classes, except now we also include the payment of principal, keeping in mind that this type of is more expenditure focused for government versus expense focused for businesses. The capacity to raise money is important, and here is all the people in our state or city versus the liability the government owes. So if you take a look at this chart here, in the case of Hawaii, here's the total debt, looks like it's for 2014, divided by the population for the year, and each resident owes over $6,000. So are you ready to pay up your share of the bill? Here is information from the city government, and you can see how the debt per person per capita for just the bond liability will go up and down. It's kind of misleading when you have a base of this amount here versus having a base of 0 showing up. Again, capacity to raise money by the government. In the case of a city government, the main way they raise money is for real property taxes. So if you look at this chart here, here is the amount of taxes collected. Looks like about $1 billion for the past year. And the value of the property is like $180 billion worth. Yeah, so they don't have to even increase remember the tax rate that they multiply by? Because the base is increasing, automatically you're going to get bigger taxes collected by the government. Here's something that's probably easier to read than the financial statements. Yeah, the service efforts and accomplishment reports, or the C report. In fact, this type of graph here is coming from the City and County C report. And I would recommend that anyone, be it accounting or non-accounting student, take a look at this type of reporting. It's very easy to read in the case of the City and County of Honolulu. Here's the cover for their C report. And the reason why it's easy to read is because it's very relatable. They determine performance, all of this stuff here, for basically services we can relate to. Police department, fire department, waste collection, things in our front and backyard that affect us every day. It's reported here in the C report. Okay, that's it for our chapter 13. You gotta read the textbook. Make sure you're ready for our quiz and final exam.